Now we move into target profit calculations, learning objective 6.3. Target profit analysis uses the break-even formula, but instead of setting profit equal to 0, we set profit equal to a desired amount. For example, for an auto manufacturer targeting $30 million in profit, we might set the following formula: the sales price per car times the cars sold, minus fixed costs, minus the variable cost per unit times cars sold, equals a target profit. Using example earlier in the chapter, let's add some numbers. The sales price was $20,000 per car. The fixed cost was $25 million, and the variable cost was $9,955 per car sold. Our target is a profit of $30 million. Solve for cars sold. In this example, the required units to meet the target profit are 5,475 cars. Again, solving for cars sold. Now let's use a contribution margin approach to compute the units required to meet a target profit. The units required would be the fixed cost plus the target profit divided by the contribution margin per car. Continuing the previous example, the fixed costs are $25 million. The target profit is $30 million. The contribution margin per car is $10,045, which is the difference between the sales price per car and the variable cost per car. In this example, the units required to meet the target profit again come out to be 5,475 cars. We can use a contribution margin ratio approach to get the sales dollars required to meet a target profit. In this case, the sales required in dollars is equal to the fixed costs plus the target profit divided by the contribution margin ratio. The fixed costs from our previous example are $25 million plus a target profit of $30 million. Divide that by the contribution margin ratio we computed earlier. The sales required to meet the target profit are $109,496,317. Now let's go to learning activity 6.7, where Hudson's Textiles has a target profit of $700,000. Using the contribution margin approach, compute how many garments Hudson must sell to reach a target profit. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 6. Now let's determine the margin of safety. Margin of safety measures how much sales can decline before a company reaches break-even. It is a measure of risk. Margin of safety equals the expected sales minus the break-even sales. The margin of safety ratio, which is a percentage that sales could decline before reaching break-even, is the margin of safety divided by expected sales. The higher the margin of safety, the less risky the business is, because sales can drop more before the company begins to lose money. Let's take a look at our previous example. If expected sales for the automobile manufacturer in our examples is 3,110 cars, and the break-even number of cars calculated earlier is 2,489 cars, the margin of safety for car sales is 621 cars, or 20%. Now let's complete learning activity 6.8. Hudson expects sales of 400,000 garments and break-even sales of 350,000 garments. Compute margin of safety in units and the margin of safety percentage. Pause here and work through the activity. Once you've finished, check your answers with the solutions provided in the back of Chapter 6.